The International Monetary Fund has cut its growth forecast for India, and it's raising serious questions about one of the biggest economic stories of the past decade. India has been the standout among the world's major economies. It has grown faster than China, the United States, and most other large players for several years running. That track record made it a magnet for foreign investment and a source of national pride. Now, the IMF is signaling that the path forward looks harder than expected. The fund revised down its outlook for India's gross domestic product, that is, the total value of everything the economy produces, goods and services combined. The IMF pointed to a combination of global headwinds and pressures building inside India's own economy. India is still projected to grow faster than most large economies, but the margin is narrowing, and that matters. Here is why the numbers matter beyond the headlines. When an economy grows more slowly than expected, businesses pull back on hiring, wage growth softens, tax revenues come in below target. That can squeeze government budgets and slow spending on infrastructure, health, and education, the investments that raise living standards over the long run. Inflation adds another layer of complexity. Slower growth can cool consumer demand and take some pressure off prices. But if the slowdown comes alongside supply disruptions, say higher import costs driven by a weaker currency, inflation can stay elevated even as growth fades. That puts the Reserve Bank of India in a difficult spot. Cutting interest rates to support growth risks stoking inflation. Holding rates steady risks dragging the economy down further. For markets, this kind of downgrade tends to ripple outward. India's stock market has drawn heavy foreign capital in recent years, largely because of its strong growth story. If that story starts to look less convincing, investors may reconsider how much exposure they want. Capital flows can shift quickly when sentiment turns. The IMF's move does not happen in a vacuum. Global demand is slowing. Trade uncertainty is running high. Financial conditions in the United States and Europe remain tight. India is not uniquely exposed to these forces, but it has leaned harder than most on its growth credentials to attract investment. That means the stakes of any sustained slowdown are higher here than in economies that never built their pitch around speed. The next round of Indian economic data on consumer spending, manufacturing output, and employment will give markets and policymakers a clearer read on whether domestic demand can absorb the pressure or whether the IMF's caution is the beginning of a longer reassessment. Watch that data. It will tell you more than any forecast. This briefing is brought to you by First Financial News. Clear, daily coverage of the economy and markets at firstfinancialnews.com.